Welcome to The Long and the Short, a show where you can expect an honest take on trading, something you won't hear elsewhere. I'm your host Sandeep Rao. In our last episode, we explored the financial product landscape in India, what's available to trade, and the different use cases for each product. Today, I want to take that discussion a step forward. We are going to dive into a fascinating market anomaly, one that has existed for decades. Not just in India, it's been documented in the US and many other markets. It's a phenomena that traders and investors have used in different ways, and if understood correctly, it can serve as a foundation for building robust, systematic strategies. As I usually do, let's start with the backstory of how this market anomaly was uncovered. We are talking about late 1970s, a period when many researchers were actively testing the limits of efficient market hypothesis, or EMH as it's called. For those of you who are new to the idea, EMH was proposed by Eugene Fama, a theory which suggests that financial markets are competitive and information flows so freely that prices instantly reflect everything known. Put simply, if EMH truly holds, you can't consistently beat the market using publicly available information, because the moment new data is released, it's immediately absorbed into the prices. One common mistake which most people make is to assume that EMH was something Pharma declared to be universally true. That wasn't the intent at all. The real purpose of framing EMH was to create a benchmark hypothesis, a baseline model of how markets would behave if they were fully efficient. Any observed irregularities or anomalies could then be tested against this benchmark. That brings us to Ken French, yes, the same French of the Fama-French fame. He was a young researcher at the University of Chicago who was working with Pharma and had started exploring the different anomalies that existed. He started with a simple question: are market returns evenly distributed across days of the week? In other words, imagine the market rises 20% over the course of a year. If we break that down by day of the week, Monday through Friday, what EMH implies is that the returns could be predictable and not systematically tilted towards a particular day. So under EMH, some weeks you might see Monday strong and other weeks you might see Friday strong, but on an average there shouldn't be a persistent pattern like Mondays are always negative or Fridays always deliver a positive return. If such patterns consistently exist, like the weekend effect or the turn of the month effect, they count as anomalies relative to the EMH benchmark. French found one such anomaly as he wrote in his 1980 paper, Stock Returns and the Weekend Effect. What he figured out was that Monday open to Friday close accounted for most of the market positive returns, whereas Friday close to Monday open were on an average negative. This anomaly was named as the weekend effect. If EMH held perfectly, there should be no systematic pattern. Weekends shouldn't always be negative. But since French consistently saw weekends dragging returns down and weekdays pushing them up, he spotted an anomaly. This paper was about the weekend effect, but it was the first to highlight the overnight effect over the weekends. A few years down the lane, in 1986, French published another paper, along with Richard Roll, another don in the world of finance. Stock return variances, the arrival of information and the reaction of traders. The study set out to understand why stock return volatility differs between trading and non-trading hours, and what that tells us about how markets process information. They decompose total daily stock return variance into two parts: trading hours, which is intraday, and non-trading hours, which is overnight, similar to what I shared in the key metrics video. The result? A surprisingly large portion of variance occurs when the markets are closed. This was the first systematic demonstration that overnight returns behave very differently compared to intraday returns. Victor Hagani, a former LTCM partner, has called it the grandmother of all market anomalies in this 2022 paper. And that's exactly what we will be exploring in the Indian context in this episode. First things first, let me set the template for what we are going to test. For any given index or stock that I would share, we would look at three things. Gaps, that is current day open price minus previous day close price. Then we will look at intraday change, which is current day close price minus current day open price. These will be expressed as percentages. And lastly, total returns for the calendar year, which is previous December close to current December close. Let's first start with Nifty. We'll take data from the year 2000 onwards. As you can see, we have year, cumulative overnight returns, cumulative intraday returns, and yearly returns, all expressed as percentages. Now look at the dataset in two windows, 2000 to 2010 and 2011 to 2025. Do you notice a difference? From 2000 to 2010, overnight returns were mostly muted and intraday carried a lot of weight. But from 2011 onwards, you see consistent greens in overnight column and consistent red in the intraday column. To view the difference from a different perspective, here's the segregated mean and median of the two periods. The shift is very clear. Most action moved to gaps. So what changed? Well, in October 2010, NSE introduced the pre-open session. Before that, the markets used to open at 9:55 am and run till 3:30 pm. After this change, markets began opening at 9:15 am instead, with a 15-minute pre-open window from 9 to 9:15. If you're wondering what exactly is pre-open and how it works, here's a quick explainer. The pre-open window itself has three parts. First, 9 to 9:08 am. This is the order entry phase. You can place, modify or cancel orders. Second, 9:08 to 9:12 am. This is the order matching and price discovery phase. Orders are frozen and the system determines an equilibrium price. And third, 9:12 to 9:15. This is the buffer phase to smoothly transition into the normal market. Unexecuted orders carry forward to the main session. This whole process can seem a bit complex, but stay with me. I'll explain with an example. Let's say Reliance closed at rupees 1,380 and today during the pre-open session, 50,000 buy orders were placed between 1,360 and 1,400, showing buyers are willing to pay up to 1,400. Similarly, 50,000 sell orders are entered between 1,370 and 1,410. Sellers are ready to accept as low as 1,370. The exchange system then determines the equilibrium price, where the maximum quantity can be matched. Suppose 30,000 shares can be traded at 1,385. That becomes the opening price for Reliance at 9:15 am. So a buy order at rupees 1,400 would execute at 1,385. A buy order below 1,385 would remain pending for the regular session. The same applies to sell orders above 1,385. Now remember, this is a simplified explanation. The actual algorithm considers additional factors like order imbalance and price priority. Now you may ask me, why does this pre-open window matter so much? Because instead of opening directly into live trading, the exchange first conducts what is called a call auction during the pre-open phase to reduce volatility and find a fair, stable opening price. And since the trades are first struck at the opening, seeking an equilibrium, a lot of days' returns now shows up in the overnight gap rather than during the intraday session. Now let's turn to Sensex and see how it fares. Here we notice a fairly consistent overnight gap performance alongside a distinct negative drift during the intraday sessions, stretching all the way back to 2000. But why is that? After all, the pre-open call auction was introduced for both NSE and BSE in 2010. If that structural change explains the shift we saw in Nifty data, why do we not see a similar impact on Sensex? In other words, Sensex has consistently shown the overnight effect across years even when there was no pre-open. Now the next question, does the same dynamic play out in individual stocks? The answer is yes, but with some caveats. Since an index is nothing more than a weighted average of its constituent stocks, any structural effect we see in the index level must also exist at the stock level. But there are two important points to note. First, stocks with higher weights in the index contribute more heavily to the observed pattern. For example, if Reliance or HDFC Bank gaps up overnight, that momentum carries far greater influence on Nifty than a smaller weighted stock. Second, while the overnight intraday drift does show up in individual stocks, it may not appear as consistently as it does in the index. That's because idiosyncratic factors like company earnings, mergers, or even a single large trade can mask or override the broader structural effect. The index, by averaging across multiple stocks, smooths out this noise and makes the pattern more visible and consistent. Here are a few stocks I've picked up to see if they demonstrate the overnight effect. Let's start with HDFC Bank. For HDFC Bank, the story mirrors what we saw with Nifty. The bulk of its return over the years have come overnight, often driven by big events and global cues, while the intraday drift has been flat to negative, with the stock frequently giving up ground once trading begins. What's striking is that this pattern persisted even after 2010, underscoring how, for large and liquid index constituent stocks like HDFC Bank, the introduction of pre-open auctions shifted price discovery firmly to the opening gap rather than the intraday session. And if you look closely at the intraday median returns post-2010 versus pre-2010, the difference becomes even clearer. Intraday goes from modestly positive before 2010 to distinctly negative afterwards. Also, it's important to note that HDFC Bank merged with HDFC sometime in 2023. That too could have some impact on the prices, I'm not sure though. Net-net, if you see, the quantum of intraday moves has mellowed, with post-2010 intraday volatility appearing much more subdued compared to the sharp swings of the earlier years. Next, let's look at another index stocks, Infy. For Infosys, the pattern is very similar to HDFC Bank. The bulk of its returns historically came overnight, especially in the 2000 to 2010 period where gaps were often huge. Intraday, on the other hand, was consistently negative in those years with several steep drawdowns. Post-2010, the story changes. Overnight continues to do the heavy lifting, but intraday drifts are no longer as extreme. Look at the medians. Intraday goes from a steep minus 34% pre-2010 to just minus 1% afterwards. Not only did the bias shift, the quantum of intraday moves also mellowed down, with the volatility far lower than in the early 2000s. To sum it up, stocks do show a tilt towards overnight gaps when you look at the returns, but it comes with a lot of caveats. Unlike the index, where the pattern is clear and consistent, at the stock level, it's much noisier and far less consistent. Now let's turn our attention to what has been happening in the US. Sometime back, I came across a video by the Tasty Life folks which said overnight drift, the pattern as seen by French, no longer works the same way, say, in SPX or NDX. So I thought, why not test it out? So here's how it looks. For SPX, the picture is quite different from India. Overnight gaps barely contribute in the long run. The median overnight return is just about plus 2%, almost noise compared to indexes' overall growth. Instead, intraday is where the real action lies, carrying most of the long-term gains. You can see this clearly in years like 2003, 2009, 2013, 2019, when the bulk of the upside came during market hours. From 2020 onwards, there seems to be a shift towards overnight, but look at it directionally. It's either up in both windows or it's down in both. So in a way, there is a continuation of overnight moves into the intraday window. So while pre-2020 SPX was very much an intraday-driven index, the trend seems to be shifting a bit now. Now let's look at the Nasdaq 100 or NDX. Here you see overnight almost being an equal contributor compared to intraday, and it has the same directional extension effect that we saw in SPX. That is, there are years where both the windows are positive or both are negative. But like SPX, 2021 onwards, the skew seems to be more towards overnight. If we look at the median returns also, it's quite evident that NDX has far greater overnight skew than SPY. So what could be the reason for NDX doing better than SPX overnight? My guess is that NDX is a tech-heavy index, and tech companies often make announcements that can shoot up the stock prices by 20-30% afterwards, like we saw with Nvidia in May 2023 and Feb 2024, and with Oracle in September 2025. This could be one of the reasons. I'm sure there could be many other macro factors which lead to it. So far, we've seen Nifty and Sensex, we saw stocks like HDFC Bank and Infy, we also saw SPX and NDX. It works in some indexes, in some markets, and it doesn't work consistently in others. But what really causes this overnight effect or overnight drift as it's called? The overnight effect arises from a mix of structural and behavioral factors. First, risk during non-trading hours. Some argue that the market is riskier when it is closed. Important news, macro announcements, earnings, mergers, etc. often come outside the trading hours. Thus, investors might demand a premium for holding stocks or positions overnight. Second, global market linkages are key, as studies show that a significant share of the US overnight drift reflects trading activity in Europe and Asia, while in India, overnight gaps in the Nifty are often driven by cues from the US markets. Together, these forces explain why close-to-open overnight returns can be very different from the intraday returns. I know what you're thinking by now. Okay, Sandeep uncle, what do we do with this data? Is it even tradable? And in a way, you're asking me, will I make money if I go long at close and exit at open? The answer is both yes and no. It's a bit complicated. Let me explain. First, we need to be precise about what close means in the context of Indian markets. There are effectively two closes you will need to understand. One is the last traded price, that is also called as LTP, at 3:30 p.m. It's the last print of a given index or stock. That is between 3 o'clock to 3:30. Then we have the official closing price, which NSE and BSE compute as a volume-weighted average price of the last 30 minutes. That is between 3 to 3:30 p.m. Now, if I have to look at Nifty Spot, in essence, the VWAP close price of all the constituent stocks is calculated, based on which the official closing price for Spot is arrived at. These two prices, that is LTP and close price, are often not the same. A big order at 3:25 p.m. can pull the official close price away from the 3:30 LTP. The second thing is, while my tests were done on the spot data, so if you plan to actually trade this approach, you should be validating it on the futures data. The reason is simple. Nifty futures is a traded product, while the index itself is just a calculated value. Futures incorporate the real-world effects of liquidity, order book depth, bid-ask spreads, and the impact cost, all of which you would face in live execution. Testing only on spot can give you a clean theoretical picture of returns, but it ignores the frictions that actually determine whether the strategy is tradable or not. Third, when you run these tests, it's important to use tradable time windows rather than relying on theoretical close and open prices. For example, instead of assuming you can buy exactly at the closing price and sell exactly at the opening price, a more realistic test would be to use a time window like 3:20 p.m. for entry and 9:20 a.m. for exit. This way, your backtest reflects the prices that you could actually trade at. While you now know which data to test this on and the other nuances about open and close times, blindly trading the close to open may still not be the most optimal way to take advantage of the overnight effect. Here are a few more ideas to incorporate into your test to find out those sweet spots. 1. Since we are largely interested in capturing the positive drift, you may want to experiment with incorporating a trend filter like a moving average or the super trend indicator, so that you can avoid some negative gaps. 2. You may want to test the correlation between the current day close and next day open. For example, if you are closing positive, only then you go long, else you don't. Just a hypothesis, something that you could test. 3. Maybe under certain conditions, you should not exit the trade at next day open and continue to hold it with a stop loss. 4. Check if there are any day of the week effects. Maybe going long on Monday's close makes more sense than going long on Friday's close. It's possible that due to several structural reasons, there could be day of the week effects playing out. There are actually many such ways to find an edge in this broad overnight anomaly. Okay, so far I've spoken about the data set to use for backtest, the different variations that you can incorporate into the test. But now before I close, I'll share some use cases of options to capture the overnight drift. Yes, the Swiss Army knife of financial products is indeed that. There is a lot that you can do with it. Let's say you want to go long on the index overnight. With options, there are many ways you could structure this trade. 1. You could simply go long call. This has a defined risk but can bleed theta overnight. 2. You could just go short put. This has undefined risk but has theta decay to your advantage. 3. You could create a synthetic future and trade it by going long on call and short on put for the long trade. This also has undefined risk. Lastly, you may even want to hedge the trade with a long OTM put, especially if you're shorting the put or doing synthetic futures. The possibilities are many, and the only limit to it is your curiosity. That brings me to the end of this episode on what I would like to call the grandmother of all market anomalies, the overnight drift. The encouraging part is that this effect is still visible in India, which, in line with Ken Friend's reasoning, suggests our market may not yet be fully efficient. For us, as systematic traders, the challenge and the opportunity lies in testing, validating, and making most of these patterns while they last. I hope today's discussion sparks some ideas for you to explore and build your own strategies. And if you stumble upon something interesting in your testing, I'd love to hear about it. Do share it in the comments. Trade safe and see you soon.